Hello, in this section we're going to look at non-current assets and good corporate reporting. A non-current asset is one where the organisation will probably receive future economic benefits from the asset over a long period of time. When we use the term non-current, we're referring to something here as an asset that will last longer than 1 year or one financial period. When we're looking at non-current assets, there are a range of standards we can apply, such as looking at property, plant and equipment, the borrowing costs, impairment of assets, investment property, intangible assets, and even non-current assets held for sale and discontinued operations. This just shows that depending on the situation and the circumstances and the type of non-current asset, one or some of all of these can be applicable. A lot of these standards you should have reviewed as part of your financial reporting, and if not, have a look back at the financial reporting course and familiarise yourself with these standards, especially if you've got an exemption or there's been a bit of a gap since you did that exam. This video is going to go over the professional application of these standards to work or an exam situation. In your exam, so many standards can be brought into one scenario, but in this section we will focus on non-current assets. So let's get started on that. In this example, we see that 2000X6 was a busy year for ABC Inc., and that's a company that's in the communications industry. The following transactions were undertaken. They purchased a trademark from a company, Call Me. The trademark is valuable and is associated with high quality unique mobile phone devices. The financial controller is very happy with the acquisition of this asset, and he believes that it's one that will keep giving ABC returns forever. However, the trademark was given a 10-year lifespan. Its purchase price was $1 million. At the end of 2000X7, a competitor began to sell mobile devices just like those under the Call Me trademark. At the end of 2000X7, the recoverable amount of the trademark was $400,000. How is a trademark accounted for in the financial statements in X6 and X7? If you are staring blankly at this question, go back and watch the IAS 38 videos in the financial reporting section. If you're still here, pause the video and attempt it, and then I will come back and go through the solution. Okay, so hopefully now you've attempted the question. The reason I started with intangible assets is because many of you, and myself included, when I was studying the standards, understood and knew very well that you didn't pay as much attention to intangible assets. However, in the real world, intangible assets are becoming more and more important, so for your exam and career you must know how to report them. ABC has purchased a trademark under which it's selling phones. You know from your revision that it's an intangible asset because it's an identifiable, non-monetary asset without physical substance. We know what a trademark is. It is identifiable, but it does not have a physical substance. A trademark is not a physical thing. It is a symbol and a thing that has built a reputation. There are three critical attributes of an intangible asset under IAS 38. They are identifiability. It's a separate trademark that ABC has purchased. Control. ABC controls the trademark, and this is assumed because they own it and nothing has been said to the contrary. The future economic benefits. This is also satisfied as the company is selling phones under this name. The identifiability in this situation was clear as it was a trademark purchased from outside of the company. But what if it was internally generated? Is it separately identifiable? It must be capable of being separated or sold or transferred, etc. This is an interesting one to examine, as sometimes the value is not in the trademark, but in the team surrounding it, so they cannot be separated from the organisation. Also arising from contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity or from the rights and obligations. So now let's look at how the asset is recorded, or how is a trademark valued. It can be valued at historical cost or revaluation cost. In X6, the purchase price was $1 million, and since it was bought on the open market, we will use this valuation in the financial statements as it was the valuation. It is then amortized over the useful economic life. Here it is 10 years with a nil residual value, so the annual amortization is $100,000. The statement of financial position will recognise the intangible asset of $900,000, i.e. the historical cost, less the amortization. The amortization will be recognised in the statement of profit and loss. For the year ended X6, the statement of financial position would read Intangible Assets, trademark, $900,000. The statement of profit and loss would read amortization of trademark, $100,000. The underlying journal entries are debit intangible assets 1 million, credit the bank 1 million for buying it if it was paid from the bank. Then debit amortization of intangible assets $100,000 and credit accumulated amortization or credit the intangible asset for $100,000. Now we move to X7 and the valuation drops to $400,000. Its current valuation is $900,000. The asset is impaired and we look to IAS 36, the impairment of assets, to guide us. The asset must be recognised at $400,000, and since the impairment happens at year end, it'll also be amortised at $100,000 and then impaired. So for the year ended X7, the statement of financial position would read intangible assets, trademark, $400,000. The statement of profit and loss would read impairment of trademark, $400,000. Amortization of trademark, $100,000. The underlying journal entries debit the impairment of the trademark by $400,000. Note this is a statement of other comprehensive income. Debit the amortization of intangible assets by $100,000 and then credit the intangible asset by $500,000. That's the question answered, or is it? What about disclosures? Under IAS 38, the disclosure would be for the year end 20X6. In 20X6, ABC Inc. bought the Call Me trademark for $1 million. This is recognised as an intangible asset under IAS 38. Its useful life is valued at 10 years and is amortised accordingly. The amortisation is expensed in the statement of profit and loss as amortisation of trademark. Call Me trademark is reflected in the financial statements as follows. In X6, purchase price of $1 million, amortization of $100,000 and carrying value of $900,000. For the year ended X7, the disclosure is the Call Me trademark is an intangible asset owned by ABC Inc. Its useful life is valued at 10 years and is amortised accordingly. The amortization is expensed in the statement of profit and loss as an amortization of trademark. Call Me trademark is reflected in the financial statements as follows, and we see the impairment losses as well here because we have that reconciliation. Again, purchase for $1 million, accumulated amortization of $100,000, current year amortization is $100,000, impairment losses of $400,000, and a carrying value of $400,000. And are there any disclosures for IAS 36? Yes, you will have to disclose this as well. In 2000X7, the impairment occurred. So in 2000X7, the disclosure would be as follows. The asset impairment in 2000X7. At the end of 2000X7, the Call Me trademark was impaired due to competitor offering, and it was impaired by $400,000. The impairment of Call Me trademark is a carrying value of $800,000, the impairment of $400,000. And now we finally have a revalued amount which will match the revalued amount that we see in the statement of financial position. So now let's look at another example. Sushi Inc. is a thriving business that owns one building where it operates a sushi restaurant from, a warehouse which is used to prepare fish either for the restaurant or to sell wholesale to supermarkets. It also owns a building which the business doesn't use but rents to local business. In 2000X7, Sushi Inc. decides to close down its warehouse operation because they purchase new machinery. Now all the wholesale fish preparation can be done in the restaurant kitchen on quiet mornings. The warehouse is valued at cost in the financial statement of $500,000 and the price they paid 20 years ago. It is not considered a depreciable asset. The directors have decided to put the building on the market and they've had it independently valued at $1 million. The costs to sell are estimated at $50,000. The warehouse has not been sold by year end, however, and there are a number of interested parties. The rental building was purchased at $500,000 2 years ago. However, house prices have fallen since then, and the building is worth $400,000 at the end of X7. The directors have no intention to sell as they are satisfied with the rental income generated by the property. Currently, it's generating $30,000 a year. The property is not depreciated as the company policy is not to depreciate property, and $10,000 was spent in the year on routine repairs. In X7, the company buys fish processing machinery, meaning that the preparation now only takes a fraction of the time and space that it did before. The machinery cost $1 million, however the organisation received a 10% discount for early payment. The useful life of the machinery is 5 years, and the company policy is to charge depreciation in the year of acquisition, and none in the year of disposal. How will this be reflected in the financial statements of So Sushi Inc. for the year ended X7? Again, please pause the video here and attempt the question. Okay, so welcome back. There are a few things we have to look at here. First, we have to tackle the warehouse. It was used in the business as a business asset up until the year of the financial statements. Therefore, it was accounted for under IAS 16 up to the end of X7. It was then put on the market for $1 million. So the standard we must look at is IFRS 5 non-current assets held for sale and discontinued operations. For the warehouse to be continued as held for sale under IFRS 5, the following conditions must be met. The management is committed to a plan to sell. We know that directors of So Sushi Incorporated are committed to sell as the property is already on the market. The asset is available for immediate sale. Again, this is true. The warehouse is currently on the market. There is an active program to locate a buyer. We know that there is a number of interested parties. The sale is highly probable and within 12 months of classification is held for sale. In this situation, the So sale within 12 months is highly probable as there are already interested buyers. The asset is being actively marketed for sale at a sales price reasonable in relation to its fair value. The warehouse sales price is based on an independent valuation, and since there is interest, we can assume this is correct. And then finally, the actions required to complete the plan indicate that it's unlikely that a plan will be significantly changed or withdrawn. Basically, to complete this sale, a buyer is needed and a company is currently looking for one, so it's unlikely the plan will change significantly. Now that we've ascertained that the asset should be recognised as one for sale under IFRS 5, how is it recorded in the financial statements? Or how do we value it first? Its carrying value up to the point of sale was $500,000 in accordance with IAS 16. The current valuation of $1 million and the costs are estimated at $50,000. The warehouse is an asset that is held for sale and must comply with IFRS 5 valuation. This valuation is the lower of the carrying amount and the fair value less cost of sale. The carrying amount is $500,000. The fair value less cost of sale are $950,000, so the warehouse is valued at $500,000 in the financial statements. The statement of financial position at the end of X7 is assets held for sale $500,000. The warehouse must be presented separately in the financial statements as an asset held for sale. When you're looking at a disclosure for non-current assets held for sale, So Sushi is selling its warehouse as the operations have moved to the restaurant building. The warehouse is currently on the market and there are a number of interested parties. Sale completion is expected in early X8. If there was an impairment, it would be noted in the disclosure. Now, what about the rental property? We apply IAS 40 investment property. This standard defines an investment property as a property held to earn rental income or for capital appreciation or both. Sushi Inc. is holding the property for rental income, so it is an investment property under IAS 40. But what's the valuation? Under IAS 40, the cost of the fair value model can be used. The fair value model should reflect the actual market value and circumstances at the balance sheet date. The cost was $500,000 and the fair value is $400,000. So how should the property be reflected in the financial statements? In this situation, I choose to continue to value the property at cost under IAS 40 as the company has no intention of selling the asset, and it looks like the market may be volatile as the value has dropped by 20% in 2 years. The statement of financial position at the end of X7 is that the investment property is $500,000. The statement of profit and loss for year end X7 is rental income from the investment property is $30,000, and then routine repairs to the rental property is $10,000. But don't forget the disclosure at the end. Under investment property, So Sushi Inc. holds an investment property that is currently rented to an unrelated party. The property is valued in the financial statements at cost. The following income and expenditure are recognised in the statement of profit and loss. Rental income $30,000, routine repairs $10,000. The fair value of the investment property is $400,000. Now the machinery. Under IAS 16, items of property, plant and equipment should be recognised as assets when it is probable that the future economic benefits associated with the asset will flow to the entity and the cost of an asset can be measured reliably. And we know from the question that these conditions for the new machinery are satisfied. The asset can be valued at cost or revaluation, however in this instance they are the same, and in the year machinery was purchased at market value. The cost is $1 million less discount of $100,000, valuing it at $900,000. The machinery has a useful life of 5 years, and the asset should be depreciated over their useful life. Since no residual value is given, we'll assume that a nil residual value, and we should appreciate accordingly, which is $900,000 divided by 5, means that $180,000 is the annual depreciation charge. The statement of profit and loss for year-end X7 will have expenses, a depreciation charge of $180,000, and the statement of financial position at the end of X7 will list plant and machinery at $720,000. As for disclosures, for each class of property, plant and equipment, the following needs to be disclosed: the basis of measuring the carry amount, the depreciation method used, and the useful lives or depreciation rates, the gross carrying amount and accumulated depreciation and impairment losses, and the reconciliation of the carrying amount at the beginning and end of the period, showing additions during the year and any acquisitions through business combinations. So in this example we need to mention both the machinery and the property, i.e. the restaurant So Sushi owns. However, the question doesn't give us the restaurant details, but if this was an exam I would mention it, showing the examiner that you know what you're doing and you know the property should be included in the disclosure. So the disclosure for the new machinery is plant and machinery, and we have the reconciliation. At the beginning of the year it was nil, but we don't know, but we're assuming that there's no machinery. We have additions of $900,000, and we have a depreciation charge of $180,000 with no accumulated depreciation. So we've got a carrying value of $720,000, which is the amount we see in the statement of financial position. This is how the transactions in questions would have been represented in the financial statements. Now there's a lot there, and you can see even if we're looking at the areas of non-current assets, there are a lot of standards you need to be familiar with. As you know, practice makes perfect, so you keep practicing, try all the multiple choice questions, and the best of luck.